Did you know there's a program that will help you bring down your interest rates for the first 2 years of a mortgage? Today, I have a mortgage expert with us to tell us more about the 2-1 buy down program.
Hi, thank you so much for having me.
Hi, how are you doing today? My name is Michael Soldana with the Amanda Vang team, and I have a great mortgage expert with us. Her name is Padi Goodspeed. Maybe tell us a little bit about yourself and how you got here.
Perfect. Well, I'm grateful for the opportunity. As mentioned, my name is Padi Goodspeed. I've been a mortgage banker for 20 years. I'm one of the top 100 female originators in the country and of the top 1%, which really just means one thing. I have a lot of experience and I have the numbers to back that up. So I'm excited to be here to answer any questions that you guys have so that we can have lots of clarity around the products that are available today.
Very good. Thank you. All right. So Patty, with the high interest rates that we've been seeing this year, some buyers are having a harder time to qualify for the same amount they did earlier in the year, or they just fear of having to pay such a high interest rate, or having a high monthly mortgage. I found that lenders are becoming creative to get buyers approved for a loan and to get a monthly payment that works for the buyers. When I heard about the 2-1 buy down program, I thought it was a great program. Maybe could you share some information on what that is and how that might help buyers?
Sure. With the experience I have, every time I hear the word creative, I tend to question, okay, what does that mean? What are the details? Because when you have to get creative, that means you're solving for a problem, right? You're solving for a problem that the normal solutions can't help. So a 3-2-1 buy down or a 2-1 buy down, these are both similar products that will allow you to take a lump sum credit from the seller and distribute it against the monthly payment over the next 2 to 3 years. So essentially, if your interest rate was going to be 4.875, what would the difference in the payment be? And the credit actually covers that difference. So it's a short-term solution for you to be able to lower your monthly obligation and over the next 3 years, and then your interest rate is actually fixed at the higher rate right now for the longer period of time. Okay, so a 3-2-1 or a 2-1 buy down is a temporary solution, and it's also important to distinguish that it's not available on jumbo loans. That product is only available on a Fannie Mae, Freddie Mac, Ginnie Mae, which is conventional, standard conventional or FHA loans. So in many markets, there are loan limits. So you have to also observe those loan limits and know whether or not you could take advantage of this option.
Thank you for sharing that. Why don't you tell me a little bit more about maybe what kind of options buyers have, especially with these high interest rates that they're seeing right now?
Sure. Most of the math that I've done with a buy down. So in a buy down, you have an option to use the seller's money, right? You have seller credit. And let's just assume that we're talking about a $1.5 million property. And let's assume that the seller credit is $22,500. On average, if you use that money to buy down the interest rate, not a temporary buy down, but an actual buy down, and you take that money and you spend it on purchasing points to lower the interest rate to feel better about the purchase and feel better about your timing, right? So the problem with this is that the difference in the payment is pretty insignificant. It's between $200 to $300. Insignificant in comparison to you taking the $22,500 and putting it in your pocket. And here's why. When you refinance, most of us understand that the high interest rate environment is temporary and an opportunity to refinance will soon come. So you'll hear many realtors say, marry the property, date the rate, right? We're hearing this as a common marketing slogan right now because everyone understands that an interest rate can change. You don't have to keep the same rate for 5, 7, 10, or 30 years. And in fact, even in low interest rate environments, people don't keep their rate for that long. So what does that mean? If I take the $22,500 seller credit and I put it in my checking account instead, and I plan on refinancing within the next 12 to 18 months, instead of saving $200 to $300 a month, with being disciplined, I can now save up to $1,250 a month in between now and the time that I refinance. So how can we show you, based on your individual goals and your individual circumstances, how to best use the credit? So I want you to go get the credits, but let's talk about how we should use the credit to be able to save you the most amount of money. And if you're refinancing within the next 12 to 18 months, then there's also going to be a cost associated with that refinance. Even if your lender, like myself, is going to be waiving their lender fees on this upcoming refinance, that's a small portion of what the cost of refinance is. Your lender's fees do not make up a massive amount of the closing costs. The cost of the rate does, your taxes, your insurance, title fees, escrow fees, all of which will also be reoccurring for you in a refinance. So again, in today's market, where the buyer has the option to negotiate on their terms and ask for a seller credit and actually get it, how should we apply that money? On a temporary buy down, on buying the interest rate, or keeping it in your pocket where you have more control of how you can allocate those funds? In my opinion, the last option is the best.
That's very interesting. I know that, like you said, it's been kind of a popular term. Sometimes you'll even see it on listings where the sellers will be offering that 2-1 buy down. And I know we've had actually a couple of clients bring it up as well. And I know what you just said was so interesting because actually I kind of ran the numbers myself, and we, work with the lenders that we work with. And in terms of the buy down versus just keeping the money in your pocket, it's I saw the exact same thing that you're talking about. But pretty much to simplify it, what you're saying is that it's better, instead of taking the buy down, that you should kind of leave it to the agent to negotiate, instead of doing the buy down, to just take it as a credit or maybe bring down the sales price and then take that money, keep that money in your pocket, and then apply that to your monthly payments. Is that what you're saying?
The strategy of reducing the sales price also makes a lot of sense because your property taxes are based on the sales price. So when you're going to analyze the data of a property and you realize, you look at the current tax bill, that dollar amount is not going to apply to you. It's most likely significantly lower because it's based on the original purchase price and further assessments from that time period. So when you buy a house today, the following year, if we bought a house today in November, by January, the tax is going to get reassessed. The property tax bill goes higher, right? So if the property tax bill is impacted by the sales price and you have extra money for that the seller is willing to leave on the table that you don't need for all of your closing costs, you should absolutely reduce the sales price. Reducing the sales price, keeping the money in your pocket, applying it directly towards the closing costs are the smartest ways to use the credit right now, especially to mitigate against what many people fear could happen in 2023, which is a shift in prices.
It kind of got me thinking, this 2-1 buy down kind of sounds a lot like an ARM, adjustable rate mortgage. But kind of based on what you're saying, do you think that like an ARM would be a better option for somebody that wants to keep those interest rates low for the first few years, and then 2, 3, or however many years down the line, when that ARM goes up, can they take that option to refinance then, and then hopefully the rates are lower?
Well, the buy down, I'll tell you the difference between a buy down and an ARM. A buy down is just putting money towards the payment. It's not actually impacting the rate. And an adjustable rate mortgage has a fixed rate period. So if you take an adjustable rate mortgage for 7 years, for qualifying purposes, which we could get into more individually, a 7-year ARM is the better choice. So if you take a 7-year ARM, your rate is fixed for 7 years. And after that, it would only adjust 1 or 2 times, depending on the product, per year. And it has a cap as to how much it'll adjust. So let's assume that the inflation rate would be under control and interest rates would be better in 7 years than they are today. If that's the case, and you had a 7-year ARM, and after 7 years, it starts to adjust, your payment would go down, because the payment is calculated based on the principal balance after the 7-year fixed period. And if the market conditions have improved, the payment would have gone down. So even in very low interest rate environment markets, people would still choose the adjustable rate because it's lower. And for a shorter period of time, they get to be able to pay more on their principal than they do interest. And it's a tool that many people use under many, many circumstances to either accelerate their principal payments or save money on their monthly payment. So most people do refinance within the first 7 years of buying a property. That's why being married to a 30-year interest rate for many people in the higher price ranges just doesn't make sense.
That's very interesting. So maybe could you kind of expand on that a little bit? So then what would be the differences between a 7-year ARM, let's say, and then a standard 30-year mortgage? Like why? We actually have a lot of clients that are doing the standard 30-year, a 7-1 ARM, I would say, is maybe not quite the majority. We do have a couple. But maybe could you tell us about the differences between those two products?
Sure. I mean, the main difference is the fixed period, right? On a 30-year fix, you have the same interest rate that's fixed for 30 years. This is a product suitable for someone who's buying their dream home, their forever home. They're putting a significant down payment, and this is the house that they're going to be in for the rest of their lives. And even under retirement circumstances, they want to have stability in the payment and no risk. I don't want to have to worry about refinancing. If the world is on fire and we're at war and my fixed rate period is up in 5 years, I don't want to have to worry about refinancing. I don't know what the market's going to do. I don't know where the values are going to be. I don't know where the rates are going to be. I want stability. I want security. I want to know exactly what I'm paying every day for the rest of my life. That's the 30-year fix. It's for you. If you're using an adjustable rate mortgage or even an interest-only product as a tool, and you know that you're saying, okay, I can pay a lower interest amount for a shorter period of time, and I'm okay with only having that stability for 5, 7, or 10 years, because within that time frame, I plan on selling. I'm going to move overseas. I'm going to need a bigger house for a family. I'm going from a condo to a single family home in the suburbs. There's a million reasons why someone would choose an ARM over a 30-year fix, and also a million someone would choose a 30-year fix over an ARM. And I think hopefully the answer expresses the theme that everything is very individualized. Just like real estate is hyper local, choosing a product, a home loan product that's best for you has a lot to do with where you are now, where you think you're headed, and what your plans are. It's a very individual thing. That's why, a general marketing flyer for a 3-2-1 buy down that circulates social media and everyone thinks it's the best thing in the world. When you analyze it, you say, wait a minute, I think there's a better alternative here. So the key thing is to always make sure you're working with someone that you can trust, who's going to be radically transparent with you, give you all of your options based on what works for you.
Very interesting. Thank you for sharing that information. Interesting. Like I said, we have a lot of clients that have 30-year fixed, based on maybe the last 1 or 2 years of business. But based on what you're saying, it kind of makes sense with interest rates where they were earlier this year and last year, the lowest rates we've almost ever seen. That's probably makes sense why a lot of our clients, at least in the recent past, have been doing 30-year mortgages. Now, just in the past few months, as we've all seen, interest rates have risen significantly. Now they're in 6 or 7% range. Would you say that now with these, assuming that they're temporary, I'm assuming that in 12 months, the world will be at least a little bit of a better place. But would you say that at least for now that the ARM product, where you have a lower fixed rate and then it kind of jumps up after 7 years, but then you're also assuming that, you'll likely do a refinance. Do you think that that might be a better strategy than a 30-year fixed right here, right now?
Sure, absolutely. I think if you can, it depends on the loan type. If you're buying a property for $500,000 with 5% down, you're getting a 30-year fix. You're not getting an adjustable rate mortgage. If you're buying a $2 million property with 20% down, an adjustable rate mortgage makes more sense. If you're buying in the Bay Area an $800,000 home or a $900,000 home or a $1 million home with only 5% down, then an adjustable rate mortgage is not the choice for you. It's a 30-year fix. It also depends on the price range and the down payment. An adjustable rate mortgage is available if you're putting 10% down or more. And in most cases, in this current market, the way that the bond market is performing, it's not a better choice over the 30-year unless you're putting 20% down.
Oh, that's very interesting. I didn't know that, but I think that makes a lot of sense. And I just wanted to jump back quickly on something that you already kind of covered was, I feel like a lot of our clients nowadays, they'll be buying their first house. They'll have a job for 5 years. They'll buy their first house and then they'll live in it. They'll have kids, but then those kids don't need to go to school until maybe 5 or 6 years down the line. So, I know that there's a kind of an older metric that said people would live in their homes on average about 10 years. But what we're seeing is that in the Bay Area, especially with how quickly things move around here, that most people will actually move out of their first home in 6 years or less. There's like a new up and coming group of people that move in 2 years, so that they'll buy a home, they'll live there for 2 years and then upgrade, like you said, kind of move from the suburbs into the city or from the city into the suburbs, from a condominium into a single family home. So maybe in that situation also, I know it's kind of situationally dependent too, but knowing that you're going to buy a new home and get a new loan, do you think that there's any reason why buyers should be afraid of the high interest rates right now, or how does that all kind of play in?
Well, afraid, no. The fear aspect of it is if I know something is temporary, then I balance emotion with logic and I say, hey, this is temporary. Now, can I still afford the monthly payment with the interest rates that are available today? So if we examine that and you think about what inflation really means and what people are dealing with, your average household in we're talking average market, so probably not the Bay Area, around across the nation are spending approximately $475 a month more on just food and transportation. So the categories, the three categories that are notable is transportation, food, and housing. So if my household requires an extra $500 to $700 just to eat and commute, and my mortgage payment is now up another $1,000, can my household sustain an additional $1,500 to $2,200 a month in expenses? So what'll happen is I'll say, okay, so let's say that Michael and I are married and we have this conversation and we say, hey, I can afford this. We can afford to pay an extra $2,200 a month as long as we don't go out to eat and as long as we don't buy extra, and we're going to have to cut Christmas shorter this year. So we're not going to be able to buy gifts for everyone on the list. Maybe we'll just make a card and send it to everyone, right? So there are certain sacrifices you have to make in order to make the decision that you can take a higher overhead for your household and purchase in this market. Now, what's the trade-off? With economics, you always have something called an opportunity cost. You give up something to get something else. And that trade-off exists with all of the decision-making we make, even when rates are lower and economic situation is brighter. So if you're willing to make the sacrifices, the trade-off for the high interest rate environment is your ability to go and negotiate a deal on your terms. If you are a home buyer watching this and you were also trying to buy a home 12 months ago, the biggest complaint that you have was that you could not compete with the buyers out there because you couldn't write the premium check to even have your bid considered. And today that element has been dissipated. But the trade-off is you no longer have to pay the extra $100,000 for the property, but you do have to take a higher interest rate for a shorter period of time. Now, over time, what do you think will happen in a low inventory environment when interest rates do drop? We assume that interest rates could be in the low 5% range by the summer of 2023. So in an environment where there's not enough homes for the people that are pre-approved to buy homes, what happens when the interest rates drop? The competition picks up. When you have people come off the sidelines and demand starts to pick up, you are going to have more competition against the same inventory that exists in the market today. So it's something to consider. You have to answer the question for yourself. Fear is not necessary. It's called, if you have a strategy and a plan and you look at your net income and where those dollars are going, and you feel that you can make up for the difference in the monthly payment on a mortgage with a higher interest rate, then you will use that as empowerment to go out here and negotiate on a deal, get a high seller credit where possible, reduce the price as much as you can. So if you got a discount on the house, but you're paying higher for the rate, you can change the rate later and you get to still build up from there. Even if prices do drop further in 2023 going into 2024, you have to remember that this is not something you just bought so that you can sell the next day. You're going to live in this house for 5, 7, 10, and in some cases 30 years. So make long-term decisions with the numbers in front of you super clear, and you'll never feel any sort of doubt about committing to buying real estate.
That's a great explanation. It's interesting you kind of brought that up where, we have this chart that we share with a lot of our buyers where it tracks the value of real estate in the Bay Area, the Silicon Valley over the last 50 years, and it's normalized for inflation. And what you see is that pretty much it just goes straight up. There's a couple small setbacks. 2007 was a bigger setback, but but everything that we've seen, any plateau, any slowdown was met by a 50% rise within the next 5 to 10 years. So it's good to hear that. And you also said something very interesting, that maybe, if all goes well, that the interest rates could be in the range of the low 5s by the summer of 2023. That doesn't feel that far away. It's interesting. I heard that they were going to increase rates, but then I was checking the mortgage rates and it looks like they actually went down a little bit recently. Maybe can you tell us a little bit about what's kind of going on now and what could lead us there?
Of course. So last Friday, we got the a CPI report. That CPI report had me jumping out of my bed first thing in the morning, throwing up my makeup. I made a reel for Instagram. I was like, oh my God, this is what we were waiting for. So if I'll take one step back, if you look at the most recent press conference with the Federal Reserve, Jerome Powell was making it super clear. And I almost felt like his point was missed by the markets. And I'll tell you what I mean. So he was the market, all of us, people, investors, buyers, real estate professionals, we were looking at Jerome Powell's press conference, hoping that he would say, all right, guys, as of December, we're no longer going to hike rates by 75 points. We're going to be hiking the federal funds rate by only 50. We wanted him to come out and say that, but he didn't. So the market responded really negatively. And after the Fed announcement, rates jumped up significantly. So we had a jump in rates. Then what he did say that I felt not enough people emphasized on was that they were going to look at the information that comes up between the time that they are having these meetings. So what does that mean? We all know that, well, not everybody. In the last meeting, when he spoke in November, what he was referring to was data that was collected from September. So what happened in October will actually reflect in their December decision. Why is that? Because the information is lagged. Just like how in your market, you noticed that back about 12 months ago, when you would get an appraisal, you were worried that it wasn't going to come in high enough for the price that you agreed to pay for the house, because the data had not caught up with the speed at which the buyers were buying. In today's market, you're getting a discount on the price, and guess what? The values are coming in higher than the purchase price. Why is that? Because the data has not caught up with the activity. That is no different than what we're seeing with the Federal Reserve and what they take into consideration when issuing these policies. So what does that mean to answer your question about rates? It means that after the Federal Reserve gave their press conference, rates went up. Then the CPI report was due. The CPI report came in at 7.7%. It was expected at 8%. So even though there was a slight increase when they were measuring from the prior report, it was significantly lower than what was expected to come in at. And the core inflation rate came in at 6.3%, where it was expected to come in at 6.5%. What does that mean? It's a very small indication that what the Federal Reserve is doing, we're hiking rates and tightening the money supply, is working. So as a result, the bond market had a great 2 days and interest rates dropped significantly. We're talking about bond prices moving upwards 160 points. That reflects a rate drop of almost 1 full percent. So that trend has to continue for that to stick, but that was a huge day in the market. So another thing to pay attention to is jobless claims. So when you have an economy, well, let's say that, again, Michael and I are business owners, we're partners, and we are placing ads to hire secretaries or transaction coordinators or salespeople. We wouldn't be posting new job ads if we weren't doing well and needed those positions filled, right? So when the job reports come out and they show that many companies are opening new positions, it sends the signal that the economy is doing very well. So the Fed is looking to see that the number of new jobless claims goes down. And then what follows that usually is layoffs. They want to go from a 3.4% unemployment rate to a 4.4% unemployment rate. That means 1.5 million people have to lose their jobs. And so far, the people reacting to just, let's say, 11,000 jobs being let go from Meta, and you have a tech company starting to let people go, people are gasping at the amount of people that is. Well, that's really small in comparison to the Fed goal, which is 1.5. That doesn't mean that they have a malicious goal of making sure people don't have jobs. It means that when the economy slows down, that an indicator of that is that less jobs are open and more people are being laid off because companies are not experiencing abundance with revenue. Why does this matter? If you have an inflation rate of 6.3% ongoing for the next 5 years, every single one of us speaking here and also the people watching it have to make more than double our income within 5 years in order to be able to afford the cost of living we have right now, even if we didn't change anything, buy a new car or buy a new house. Within 5 years, we would have to work double the amount of hours or make double the income in order to be able to afford to live. So a high inflation environment is not good for our ability to live, right? It's not sustainable. So they have to get that number down. So in order to go from 6.3% down to 2%, you have to see the economy slow down significantly. So if the reports in November, we saw the CPI reports going down, the jobless claims reports shift and show less new jobs are being opened, you can 100% expect that the Feds between December and January will stop raising the Fed funds rate by 75 points and start going down to 50. They do have to keep raising the rate, but they can tighten those increments. And when they do that, it's going to send a great message to the bond market that we're headed towards the second half of this, and it's not going to keep getting worse. That's good for the bond market, which is in turn good for the interest rates. This is exactly why we think that by next summer, we're going to be able to see a nice improvement to interest rates.
That's really good to hear. I feel like, we've been talking about a crash and a recession, but at the same time, when you kind of look at the data, I feel like we're on the right track. I know Meta did just do those layoffs, and there's a lot of weird things happening in tech right now. But like you said, that's actually a very small minority of the entirety of the United States and the jobs that we have here. So I can see how, everything you said really makes sense. And, as long as things kind of go on their track, I think I can definitely agree with you that we are headed the right direction.
The word crash is just kind of overused in this situation. If you think about what's happening, that even in, I think, the worst of circumstances in 2023, what you're seeing is prices go to the pre-pandemic levels. So if you just kind of think about what that means, when you have a lot of people lined up in a store for a good or service that is limited in quantity, it's going to go up in price and still fly off the shelf. But then if you waited 2 more weeks for it to be in season and there's an abundance of that fruit or vegetable available, people are going to pay normal prices for it. In 2020 and 2021, when the Fed dropped the interest rates to 0 as a response to the pandemic, well, of course, you had tons of people buying in a very low inventory environment and prices rising. So if you compare the retraction in prices in 2022, 2023, and 2024 to that, you might think, oh my gosh, it's 30 to 40% change in prices. It's a crash. But if you look at the overall picture, you'll realize that it's really just a course correction that was absolutely necessary.
That's good to hear. That's good to hear. I'm glad. I feel like, there's a lot of uncertainty right now, but as a buyer of real estate, I think that I can agree. I think it's kind of an opportunity where, inventory is not super low in the Bay Area, but I think a lot of people are discouraged because of what's going on in the high interest rates. And the nice thing is that now you're not bidding against 10 people for a house. You've got, maybe 1 or 2 other bidders. Prices aren't crazy. They're actually a little bit down from the peaks that we saw earlier this year. And I think that actually gives buyers a lot of opportunity. But then I think, just like we've been talking about, the only hurdle, or the biggest hurdle, is actually the interest rates. But pretty much what we covered in this conversation, what we're saying is that, these interest rates should hopefully be temporary, and whether they are or not, there are a handful of strategies that are very situationally dependent, but can help, buyers kind of manage their risk and to have something that'll work for their income and for their goals. Do you have any last words on the 2-1 mortgage, or any tips for buyers to succeed in today's situation?
No, just remember that everything is tailor-made to fit you personally. There is no one-size-fit-all mortgage product. No one walks in with the same amount of information or history. So do what's best for you, and don't forget to ask for the seller credit.
Right on. Well, thank you very much. Thank you very much for the information and for your time today, Padi. For our audience out there, if you are interested in a 2-1 buy down or something similar, like we just talked about, an ARM, a 30-year, or just take that seller credit, put it in your pocket, don't hesitate to reach out. Our contact information is below. Padi, do you have a website as well?
Yes, I do. It is just padigoodspeed.com.
Very good. Very good. We'll make sure to put that text up on the screen. Yeah. So, if you have any general questions about real estate loans, home loans, or you're interested in buying or selling a house, don't hesitate to reach out to us today. My name is Michael Saldana with the Amanda Vang team, signing out for now.